what is the real reason why Lemonade is better than Root long term. Ciao guys, I'm going to quickly introduce my article. As always, this is published on lorenzo2cents.com. So if you subscribe, you will receive it in your inbox. If not, go to lorenzo2cents.com and take a look to know all the details. So I'm quickly going to introduce it. First, both Root and Lemonade are telematics-driven car insurance, right? We are specifically speaking about car here. I wanted to do a comparison and head-to-head of the two business. So what is their goal? Keep loss ratio low while growing customers fast. And of course, the key variable to achieve this trade-off is data. This is a nice infographic that I have taken from Root shareholders letter. Increasing data drives better risk scores. Better risk scores drives better pricing. Better pricing leads to better customer experience. Better customer experience drives growth. Growth creates more data, and so on in a reinforcing cycle. So this is the edge that these insurers have compared to incumbents here, right? Okay, so they are both playing out the same playbook here. Let's get right into it. So the first side of the equation is minimizing loss ratio, and it comes down to the quality of data, to the quantity of data, and the variety of data. So I think we can say, it's difficult to say this from the outside, but I can assume that both technologies are equivalent and are performing equivalently. Why? Because both Lemonade and Root use their app as a sensor to collect all this data. So the position, accelerometer, and so on, right? So let's assume that the quality and variety of data are equal, just because I'm not sure if it is true, but I don't have any tool and enough information to assess differently. And anyway, I believe even if one technology is superior, in eventually the follower can close the gap, because again, they are using the same sensor. So it's just about adding, eventually collecting more data from the app, no? So let's assume that they are equivalent there. Then what really makes the difference is how they use this data, the algorithm effectiveness, and the quantity of data, so the miles driven by their users and the related collected data. So again, assuming that the algorithm effectiveness is the same, because I don't have any evidence that is different, who has more data here? Well, Lemonade claims to use Metro Miles data from 2013. It is the company they acquired, the car insurance. Root started in 2015. I think here Root has a clear advantage, right? It's a first mover edge that they have, and this is clear, I think, from the gross loss ratio. So you see the gross loss ratio of Root is way lower. It's below 60 now. That is one of the best in the industry, of course. This is, I've compared, it's too early to compare head to head the car part of the loss ratio for Lemonade with Root, because this just started, even if they are already improving. So here I'm comparing the total loss ratio, gross loss ratio, so for renters plus home, pet, and term life, so for all the product of Lemonade, with the Root gross loss ratio, that of course is mainly about car. So it's not a peer-to-peer comparison here, but I wanted just to show that Lemonade can do this, okay, can use data, they have proved it. So they will do the same with car, and these are already appearing in the number. So I expect that these two will converge, right? So for now, no doubt, Root is the winner here. They have already proved that they can use this data in a good way and achieve superior return. Lemonade has to prove it, but there is no reason to think they are not able to prove it. Okay, so second part of the equation is maximizing IFP growth. And this is somehow connected to the first, because despite insurance premium and insurance prices are quite inelastic, I think we will see a shift here, right? Because younger generations, first thing they do, they surf the internet and they look for a better pricing. So they are more inclined to use a new insurer, right? That they never heard, because they even heard about any incumbents so far. So I think price is playing a bigger and bigger role here, and the demand is becoming more elastic. So price reduction, which often means a higher loss ratio, goes hand in hand with the faster IFP growth, right? The lower the price, the higher the loss ratio, the faster the growth, and vice versa. So they need to balance these two. So to capture how these two companies are able to balance, to find a good trade-off, I think I can say coined this metric I had never seen before. So I just adjusted the rule of 40 that I think all of you knows. So it's some growth or revenue with operating margin normally. So what I'm doing here, I adapted it to insurers, and this is the sum of in-force premium IFP growth and 1 minus gross loss ratio, right? So we want to see this the higher possible, and 40, I believe it's still a good threshold to understand if a company is doing good or is not doing good. Okay, so we see here Root still is leading, right? It's around 60. Lemonade, and I'm comparing only the car part of Lemonade. So if we look at the all product is different picture. Lemonade probably is close to 60. Lemonade is around 40. It's already doubled it from Q1 to Q2. So you see the improvement is already relevant. The trend is the one that we want to see. And I think it will easily, in the next 1, 2, 3 quarters, catch up, close this gap with the Root. Also because it's starting from a low base of in-force premium for cars, so it's easier to grow from here, right? And their gross loss ratio is going to improve. So I think we will see this gap closing. So not much relevant, this metric so far, but it will be fun to monitor this, because I think once Lemonade start approaching maybe 1 billion of car premiums, 1.5 billion, that is more or less what Root is at now, then it will be very useful to compare the two, right? Because I think from what I can see, Root is plateauing growth here. Now it's around 19%. And so probably this is the critical mass, 1.5 billion of IFP, where we can start comparing the two. Okay, so here again, Root is a winner. Lemonade is catching up. Next, Root leads with distribution excellence. I think, no doubt, Root, I believe, is leading because of distribution. They are excellent at this. So Despite the hyper growth we saw in 2024 is coming mostly from their D2C channel. They invested in marketing and they had a very huge return. We saw triple digit growth there. Now they are pivoting. It was still a good portion of the in-force premium of the new writing in this case, but now you see that the partnerships percentage of the new writings is almost 50%. So what does it help with? First, it's very cheap to, it's cheaper to grow with partner than with direct to consumer, so channels, app, whatever, marketing, because you don't have to do marketing, right? Partners are doing it for you. You are on the platforms of the partners, like Carvana, for instance. So, and even the growth, you have visibility that is order of magnitude higher than just doing the DTC, direct to consumer. So more growth at a cheaper cost. This is what is really differentiating Root from Lemonade. And Lemonade is not going down the same path here. And again, this is another win for Root. It's clearly visible in the financials saying that Root is growing faster, premiums, and it's also already profitable, differently from Lemonade. So again, another point to Root, right? So why at the end I am invested in Lemonade and not in Root, and I'm not planning to change this, and then I'm even not planning to add the Root so far. I could change my mind, but so far I'm not. So the reason is quite straightforward. If I look at the financial metrics, Root is the winner, undisputable winner. Okay, and by the way, I need to be honest here. When I started this comparison, I didn't think that Root was that good. So for me, it's a big surprise. And guys, it's a really good company. It will do well in the short term and in the long term. So why I'm invested in Lemonade? Because I think Lemonade is pursuing a different game here. They are going for the long term. They are sacrificing short-term gain for long-term gains. They are building, and they have built already, an autonomous organization, right? So what does it mean? It means that they are selling, first of all, most of they are selling most of their policies through AI. So there is a chatbot they call Maya that is doing most of the work, right? No human involved. It's a process. It takes a few minutes. I believe they claim 3 minutes average to sell the policies. There is no human involved. Same technology they are using to process claims. So 98, I believe, percent of the claims are managed by AI. And when there is something that is not manageable by AI, then it gets escalated by AI to humans. So they are building an organization that is taking inputs from mainly their app and from external factors, and is processing these inputs and is executing, selling, managing the claims, paying the claims, and so on. This means that we will see a point where revenue keep growing at a faster and faster pace and are basically disconnected from their headcounts, because AI is doing everything. So growth will be just a function of marketing investments. and they have the best data to understand where to invest to have a good return, no? Because in different times, it depends by the competition. So in different times, you could invest the money on pet or on cars, depending on what the competition is doing and depending on how much does it cost to get a lead, right? So where we see this, where we can see that this is working. Well, first, we can check the LAE, loss adjustment expense. These measure all those expenses that are attached to a claim payment. So for instance, all the overhead, management of the claim, and so on. Again, as this is managed mostly by AI, we want to see this value very low, right? This LAE as a percentage of IFP, I believe here, yeah. So Lemonade, it's around 7%. That is one of the best in the industry, despite still the small base of revenue compared relatively to Root, but even to the incumbents, right? So yeah, and Root has more or less the same, but let's not forget that Root is first bigger in terms of premiums, enforced premiums, but another advantage that Root has and that Lemonade will benefit soon from is that cars have a higher premium compared to renters, for instance, but also probably to home insurance. So the average premium of Lemonade is much lower than the average premium per customer of Root. So this means that to manage a claim more or less is the same work, but it is weighted on a higher premium in the case of Root, right? So this is 7% is really significant. This is what I want to say. And by the way, one thing I forgot to say, another advantage of Root is that selling a car insurance, it's way easier, at least at the beginning when Lemon started, to than selling renters, because it's renters is something optional, right? You can get it or you can not get it. It's the same, and you need to educate. So Nemonet needed at the beginning to educate customers that this insurance was needed. While if you sell car insurance, you don't need to do this. You just need to acquire the customer. That is very different. Everyone needs a car insurance, and everyone knows that he needs it. So this is another thing that allows Root to scale in a more profitable way. Okay, so where do we see this autonomous organization playing out? We see, I think this is the most significant metrics. IFP, enforced premium, divided by employees. So again, Root here is leading. Yeah, I agree. But the Lemonade trend is much smoother here. So you see it's growing steadily, while Root is more up and down. There is no real trend here, even if it looks an uptrend. And maybe they will do good. But I think Lemonade is in control of this. And how you can also see this is because of the full-time employees. That, of course, here is at the denominator, right? But we can understand better from looking directly at the full-time employees number. So Lemonade is flat or is decreasing even better, right? From 2022, while increasing IFP. While again, Root looks it's actually increased in 2024 compared to 2023. So again, it looks like that Lemonade has this really in control, and I expect full-time employees will remain quite flat even for the next 1 or 2 years, while revenue, IFP and revenue, will skyrocket around 30% of growth. per year over year. And this is what really I'm looking at. This is the main metric that I'm checking. As these keep going up at this pace, then I'm happy. I think they really are, and they are going to be more and more an autonomous organization. This is what I'm seeing in Lemonade. And once they have this structure in place, that is about organization, it's about tools, AI, and so on, they can use this playbook for any kind of insurance, right? And they already have more products that they can use even to become stickier and to have an higher retention than root that is just car. And yeah, maybe they are selling other products, but these are third-party products, so they don't have full control of this. Right, so guys, just to wrap up here, Lemonade, I believe, is playing a different game, a bigger one, a longer term one. And this is why I invest in Lemonade, and I'm not planning to change this. Lemonade is my, I believe, second position in the portfolio, second only to HIMS. And since I published my first deep dive on lorenzo2cents.com in September 2024, it's already a 3x for me, Lemonade. I expect this could be a 10x or 20x in over the next 5 years, because still the market is not appreciating what I'm telling you today. And because I think this is mainly, everyone is worried that Lemonade is not profitable and so on, but Lemonade has positive free cash flow, and they already shared they are going to be profitable next year. So as soon as we see Lemonade printing some profitable quarter, probably the price, the stock will be repriced. Okay, good. So content of this analysis is for entertainment only. Just do your own due diligence, no financial advice.